Welcome to BBIU. This episode is based on a public article from Biopharma Business Intelligence Unit, an independent strategic intelligence platform analyzing biopharma, regulation, geopolitics, capital, and structural risk. We do not treat events as isolated headlines. We read them as signals inside larger systems. This podcast provides a concise public entry point into the issue, while the institutional version develops the full structural assessment for decision makers facing high consequence uncertainty. South Korea's fall to 13th in foreign exchange reserves and the pressure beneath the won. Joel 4th, why record semiconductor exports and a large reserve stock are not eliminating Korea's growing dependence on institutional stabilization. Institutional relevance snapshot. What happened? South Korea fell to 13th place globally in foreign exchange reserves based on end May 2026 data, after ranking 9th at the end of 2025. The Bank of Korea subsequently reported reserves of approximately $427.36 billion at the end of June 2026, slightly higher than the previous month. The decline in ranking did not result from a continuous collapse in Korea's absolute reserve stock. Other countries accumulated reserves more rapidly, while Korea's total remained broadly stable. Why this matters now? The ranking change occurred while the won remained weak. Foreign investors were reducing Korean equity exposure, and authorities continued using multiple mechanisms to stabilize foreign currency markets. At the same time, Korea was reporting record semiconductor exports and a large trade surplus. The contradiction is therefore not that Korea lacks foreign currency resources. It is that substantial resources and institutional intervention are being required despite exceptional export performance. Who should care? This development is relevant to institutional investors, multinational companies, corporate treasury teams, lenders and credit committees, supply chain leadership, pension and sovereign risk analysts, strategy and public policy units, organizations with long-term commercial exposure to Korea. What kind of decision this affects? The issue affects capital allocation, Korean equity and credit exposure, foreign exchange assumptions, market entry timing, counterparty selection, manufacturing and supply chain planning, long-duration contracting, treasury and liquidity planning. Executive summary. South Korea's fall to 13th place in global foreign exchange reserves is not evidence of an imminent reserve crisis. The country still holds more than $427 billion in reserves, continues to generate large trade surpluses, and remains one of the world's most important semiconductor exporters. What is being misread is the relationship between those visible strengths and the growing institutional effort required to preserve currency and market stability. The won has remained weak despite record semiconductor exports. Foreign investors have reduced Korean equity exposure after realizing large gains. The National Pensions Service has become increasingly relevant to both foreign currency demand and domestic market liquidity. Public authorities have also expanded the use of fiscal, regulatory, and administrative measures to contain pressure across the economy. The broader shift is not a conventional collapse. It is the movement toward a system in which stability depends increasingly on the repeated use of public and institutional buffers. The institutional question is no longer whether Korea possesses those buffers. It is how long they can continue absorbing pressure without becoming exposed to the same underlying semiconductor, currency, and capital market cycle. Observable surface. Several visible developments define Korea's current position. Foreign exchange reserves remain substantial. Korea held approximately $427.36 billion in foreign exchange reserves at the end of June 2026. The reserve stock remained higher than it had been 2 years earlier. The fall in global ranking was therefore comparative rather than evidence of a direct four-position loss in absolute financial capacity. Official dollar sales continued. Korean authorities sold dollars for 6 consecutive quarters. Cumulative net sales during that period reached approximately $45.35 billion. The reserve stock did not fall by an equivalent amount because reserve balances are also affected by investment income, changes in securities values, currency conversion effects, foreign currency deposits, swaps, and asset maturities. The won remained weak. The exchange rate moved from approximately KR 1,364 per dollar at the beginning of the Lee Jae-myung administration to levels above KR 500 during 2026. This occurred despite strong exports and a large current account surplus. Semiconductor exports reached exceptional levels. Korean merchandise exports reached approximately $102.25 billion in June 2026. Semiconductor exports represented close to 44% of the total. The increase was driven by global demand for high-bandwidth memory, DRAM, AI data center infrastructure, advanced computing and storage systems. The Korean equity market became more concentrated. Samsung Electronics and SK Hynix represented an unusually large share of KOSPI market capitalization. The main index rose sharply, while smaller companies and the KOSDAQ performed much less consistently. Foreign investors reduced exposure. Foreign investors sold large volumes of Korean equities during the first half of 2026. Much of the selling reflected profit realization, portfolio rebalancing, excessive semiconductor concentration, reduction of crowded AI exposure. NPS policy became increasingly relevant to market stability. The National Pension Service adjusted parts of its domestic and overseas allocation framework and continued using foreign exchange hedging and swap mechanisms. These decisions were presented as portfolio management measures. They also affected foreign currency demand and domestic equity market liquidity. The unresolved tension. The visible data explain part of Korea's position. They do not explain all of it. Strong exports have not produced a stronger one. Record semiconductor exports should increase dollar inflows. But export earnings do not automatically become domestic dollar supply. Companies may retain foreign earnings abroad. Korean households and institutions may continue purchasing overseas assets. Foreign investors may sell Korean shares and repatriate profits. A trade surplus, therefore, does not guarantee currency strength. A stable reserve stock does not mean intervention has been limited. The headline reserve balance can remain stable while authorities sell substantial amounts of foreign currency. Investment income, valuation changes, deposits, and swaps can offset part of the reported decline. The published reserve figure therefore shows the size of the stock. It does not by itself show how intensively that stock is being used. A rising stock market does not necessarily indicate broad financial strength forth. The KOSPI rally was supported by genuine semiconductor earnings and AI demand, but it also became increasingly concentrated. Foreign investors were able to reduce exposure while domestic households and institutions absorbed a larger share of the remaining market risk. The result is a market that can appear exceptionally strong while becoming more dependent on a narrow group of companies and domestic liquidity. Partial structural diagnosis. The Korean economy is not simply deteriorating, nor is it uniformly strong. It is becoming increasingly divided between an external and financial surface supported by semiconductors, exports, and major listed companies, and a domestically constrained economy facing household leverage, weaker purchasing power, corporate pressure, and rising dependence on public support. The main structural shift is the growing use of institutional balance sheets to preserve continuity. Foreign exchange reserves are used to limit disorderly currency movements. The National Pension Service affects both domestic market liquidity and foreign currency demand. Fiscal policy supports consumption, strategic industries, and financially vulnerable groups. Companies are asked to preserve employment, moderate price increases, invest domestically, expand overseas, and repatriate foreign earnings. None of these measures alone indicates a crisis. Together, they suggest that Korea's strongest institutions are being used increasingly to absorb pressure generated elsewhere in the system. The tension is between short-term stabilization and long-term institutional flexibility. The more frequently reserves, pension assets, public credit, and corporate balance sheets are used to preserve current stability, the less optionality remains if a larger external shock arrives. Selected driving forces. Semiconductor concentration. Semiconductors are no longer only an export industry. They now support the trade surplus, corporate profits, tax revenue, the KOSPI, National Pension Service returns, industrial investment, Korea's position in the global AI supply chain. This provides Korea with a powerful source of resilience. It also increases dependence on one cyclical sector. The unresolved question is how much of Korea's apparent stability now depends on continued global AI capital expenditure. Structural dollar demand. Korean households, companies, financial institutions, and the National Pension Service all hold or acquire substantial foreign assets. This creates persistent demand for dollars even when Korea reports a trade surplus. The unresolved question is whether the won's weakness reflects a temporary market imbalance or a longer-term change in the preferred location of Korean capital. Institutional stabilization. The Bank of Korea, government ministries, regulators, and the National Pension Service have all taken measures that affect foreign currency supply, domestic liquidity, and market confidence. These measures may be rational individually. The unresolved question is whether repeated coordination is becoming a permanent feature of the system rather than a temporary response to volatility. What is most likely being underestimated? Semiconductor strength is masking concentration risk. The current semiconductor cycle is generating extraordinary export revenue and market value. That strength can delay adjustment in weaker parts of the economy. It may also make Korea more vulnerable if investors, pension assets, government revenue, and currency expectations become increasingly dependent on the same industry. The risk is not that semiconductor companies are currently weak. It is that too many parts of the system are relying on their continued exceptional performance. NPS is becoming relevant beyond pension management. The National Pension Service is one of the world's largest institutional investors. Its foreign asset purchases affect dollar demand. Its domestic holdings affect equity market liquidity. Its hedging decisions can influence the won. This creates a potential tension between maximizing long-term pension returns and supporting short-term national financial stability. The existence of that tension does not prove that pension assets are being mismanaged. It does mean that NPS can no longer be analyzed only as a retirement fund. Limited forward paths. Path 1, semiconductor-led continuity. Broad condition. Global AI investment remains strong and demand for advanced Korean memory products continues. What it would look like: semiconductor exports remain elevated. The trade surplus stays strong. The chaos buy remains supported despite volatility. NPS returns remain positive. Authorities continue managing the won without a disruptive policy shift. What remains unresolved? Korea avoids an acute adjustment, but dependence on semiconductors and institutional stabilization becomes more deeply embedded. The system remains stable, but less diversified. Path 2. Cross-market convergence. Broad condition. Semiconductor expectations weaken while foreign selling, currency pressure, and domestic leverage continue. What it would look like: major chip companies reprice, the KOSPI and won weaken at the same time. Domestic investors become less able to absorb foreign selling. Official stabilization measures increase. Fiscal and monetary policy face more difficult trade-offs. Institutional consequence. The issue would no longer be limited to one industry or one market. It would become a broader test of how much pressure Korea's public and institutional balance sheets can absorb simultaneously. The full conditions under which this transition becomes decision-critical are examined in the institutional version. Institutional relevance. Without the full exposure map, several common planning assumptions may no longer be reliable. Strong exports do not guarantee a strong currency. Treasury and investment decisions based only on trade surplus data may underestimate structural dollar demand. A rising KOSPI does not represent the entire Korean economy. A concentrated semiconductor-led rally may conceal weaker domestic companies, household leverage, and foreign investor exit. A large reserve stock does not reveal intervention intensity. Reserve adequacy must be considered together with official dollar sales, currency pressure, external liabilities, institutional swaps, private overseas investment. Pension strength cannot be assessed only through recent returns. Strong NPS performance can coexist with demographic pressure, higher future contributions, growing domestic exposure, and expanding macroeconomic role. Announced investment does not equal executed investment. Large semiconductor, AI, and overseas investment programs remain dependent on demand, financing, corporate approval, energy and infrastructure capacity, currency conditions. These distinctions affect capital allocation, market timing, counterparty assessment, and long-term exposure to Korea. The The specific implications differ materially by institution and are not resolved at the public layer. Why this matters? Korea still possesses substantial economic and institutional strength. Its semiconductor companies are globally strategic. Its reserve stock remains large. Its government retains fiscal and regulatory capacity. Its national pension service remains a major source of long-term capital. The risk lies in interpreting those strengths independently. A large reserve stock can coexist with intensive intervention. A rising stock market can coexist with foreign selling. A trade surplus can coexist with a weakening currency. Strong pension returns can coexist with increasing institutional obligations. The principal decision risk is not that Korea has already entered a crisis. This judgment is supported by persistent won weakness despite record exports, 6 consecutive quarters of official dollar sales, foreign equity outflows, growing semiconductor concentration, the increasing relevance of NPS decisions to currency and market conditions. The principal limitation is timing. Korea retains substantial reserves, globally competitive companies, fiscal capacity, and institutional resilience. The current structure may remain stable for an extended period if the semiconductor and AI cycle continues to generate exceptional income and confidence. Selected BBIU validation signals. Earlier BBIU analysis identified that Korea's foreign exchange pressure was becoming increasingly administrative rather than purely market-based. In Korea's FX stress becomes administrative, BBIU examined the shift from conventional intervention toward measures influencing exporter conversion, overseas investment, institutional hedging, and domestic dollar supply. Subsequent developments increased the relevance of that assessment. BBIU also warned in Korea's surface strength and the structural stress beneath it that reserves, equity performance, and semiconductor exports should not be interpreted separately from household leverage, capital flows, and institutional intervention. Korea's fall to 13th place in reserve rankings did not prove that thesis by itself. It provided a new reason to reassess how those variables are interacting. Institutional version availability. The institutional version expands this analysis with the full transmission mechanism, actor-specific exposure mapping, scenario conditioning, decision thresholds, contract and currency implications, portfolio and liquidity considerations, counterparty and supply chain risks, risk reduction options. It is intended for organizations evaluating direct strategic, regulatory, industrial, contractual, treasury, pension, or capital exposure to South Korea. Access is available for organizations with a defined decision context through BBIU's Structural Decision Context channel. When BBIU analysis creates friction, the friction itself is not the issue. The issue is what that friction reveals about structural exposure. This episode presents the public version of BBIU's analysis. The institutional version goes further. It includes the full structural assessment, deeper regulatory and geopolitical mapping, capital risk implications, and the decision-level interpretation designed for investors, executives, and institutions facing high-consequence uncertainty. BBIU's public content is intended to frame the issue. The institutional version is designed to support judgment. To request access or submit a confidential decision context, visit .biopharmabusinessintelligenceunit.com.